My name's Revelle. I'm the Managing Director and CEO of Pursuit Minerals. Pursuit Minerals is an Argentine pure play focused on our Rio Grande Sur lithium project in the Salta Province of Argentina, as well as our Sascha Marcelina Gold project in the province of Santa Cruz.
Good to meet you. Good to chat. Look, Aaron, for people perhaps new to this story, do you mind giving us a bit of background on yourself? Where have you been? What have you done? How's that relevant to what you're trying to do today?
Absolutely. So Pursuit Minerals is an ASX-listed lithium and gold developer in Argentina. Our flagship is the Rio Grande Sur project. We joined the company in and around the end of 2022, start of 2023, when Pursuit purchased the Rio Grande Sur project. My chairman, Tom Eady, and myself joined the company when the acquisition completed. Tom is a very well-known resources entrepreneur and figure within the Australian mining sector, most notably from Syra Resources, the graphite play in Africa that he took from a 10 mil market cap to over $1 billion in market cap value. He's also currently chairman of Southern Cross Gold, which is an Australian gold explorer and developer, which again went from several tens of millions of market cap at IPO all the way to, I think it's around 2.5 or 3 billion now in market cap. So very well credentialed individual, a very well experienced geophysicist who has worked with me for a number of years, who joined the project and joined Pursuit. We're also joined by Colin McKenzie. Colin is a capital markets expert who was until recently the chairman of Shaw and Partners, which is a larger mid-tier broker here within Australia, with significant capital raise expertise under his belt. More recently, he's moved into the boutique space and runs a private client division of a group called Solomons in Queensland, where he's based. So very well-credentialed board. We also have myself and my COO. We both met working at Recon Lithium, which is now owned by Rio Tinto. I started my career there in 06, 07. He was around that time as well. But we've worked together for over 15 years in Argentina. More recently with a company I founded called Central Resources. Both myself and my COO worked that project through to acquisition. It was founded in 2018, purchased by Arena Minerals in 2020 when the lithium market was at a significant low. And then 2 years later, with very little work done, was sold to Ganfeng for over 340 million Australian. So the board, the team, we've all come back together in 22. And since then, we've really put some meat on the bone of the Rio Grande Sur project. When we acquired it, it was 5 separate licenses, 5 different vendors, a patchwork quilt. There had been some historical exploration on Rio Grande through a TSX company that had done some light exploration, an existing NI 43-101 resource. But for us, we drilled several holes. We've stood up a pilot plant that's produced 99.5% technical grade lithium carbonate. We've completed a 5,000-ton PFS and established a maiden JORC resource and a maiden reserve. So a lot of work done in the last 3 years, and now we're working towards bringing this project into production and the development pathway to do that. We also have a nice little gold project that we picked up at the end of last year. When I joined Pursuit, we had some WA gold assets, which we sold out. We wanted to complement the portfolio, and the Sascha Marcelina Gold project was a nice find that we were able to do with that. So that's in the Santa Cruz province, where all of our assets are in Argentina, Argentinian focused. We've all worked in Argentina for a significant period of time. So we understand the jurisdiction really well and have a really credible and well-credentialed in-country team that have allowed us to move rapidly and develop these projects quite quickly, which we're very fortunate to have.
Okay. So that's the background. That's the team. I need to talk to you about a couple of things before we get into the project proper. Lithium market and Argentina. Okay, I think not everyone will know a lot about either of those. They've all seen some like a false dawn. It seems in the lithium market recently. People have made money on the way up and lost a lot of money on the way down. Why is lithium trending again? And how do you think it plays out this time?
What we're seeing now is a return from surplus to deficit. However, unlike previous cycles, this is a structural deficit with increasing demand drivers that weren't present in previous cycles. Lithium is very cyclical. It goes up when there is heightened demand, new supply will come online, and then the demand drops with the new supply, and you get this sort of wave effect with prices. And you do get price spikes like the 80,000 per ton that was achieved in 2023. However, what we're seeing now is if you look at the demand profile, we're going from about 1.5 million tons to forecast of 3 million tons plus from 2030. A lithium project, a really good one, will take anywhere between 5 to 7 years to bring online. And that's assuming that you can find it, develop it in 2 years, and then construct it in 3 with flawless ramp up. No project has achieved a flawless ramp up when they've all been brought online in the past decade. So from that perspective, if you think about the market today, you're talking Rio Tinto's portfolio, you're talking SQM's portfolio, you're talking Albemarle's portfolio, and doubling those projects. And these are some massive projects. La Negra in Atacama is a multi-billion-dollar project. You have, Olaroz, Phoenix in Argentina, now part of the Rio Tinto stable. That Phoenix has been operating since '87 under formerly FMC. Then you look at the green bushes of the world, the Pilbara or PLS Resources portfolio, doubling the outputs of these to feed the spodumene converters in China. That's a big ask for a small industry where if you look at majority of the new projects coming online, majority of them have all come out of Argentina. And to take the the supply of that demand from 1.5 million tons to 3 million tons, by 2026, this is being forecast for 2030, so 3.5 years away. There is going to be structural deficits in the market where, and if you look at the demand drivers, we went through the narrative 2020, 2023, and arguably sort of the 2015 to 2018 cycles were all really EV driven. The emergence of Tesla as a mainstream market. During that period, Tesla became the most expensive auto manufacturer by market capitalization in the world, went through a boom period where, significant Teslas are now on the road. However, whilst the EV story is still growing, and we are seeing it still grow in Europe, in North America, and even in China, however, you're also now seeing the data center component come into it, where you've got BESS energy storage. Go back 3-4 years, no one was really looking at that section of the market, and now BESS energy storage is estimated to capture 30% of market share in terms of demand. So the demand drivers are structurally strong. In terms of EVs, China's already hit the tipping point where they'll go full electric within the coming years. We're seeing continued adoption in the States, we're seeing continued adoption in Europe, but now you've got the AI data centers, which are all powered by these battery packs with solar panels on the roofs. You look at the critical minerals thematic, you've got AI and the emergence of AI. Well, AI is powered by critical minerals, with lithium being at the top. So from that perspective, the market's different from previous cycles, where we're now entering a much longer term structural deficit where new supply is required. And fortunately for us, a lot of new supply is coming out of Argentina, which places us in a very good position.
Okay, well, maybe we'll come back to that. We'll talk about supply demand in a bit. Let's talk about the Argentine factor. Obviously, Milei's come in. It feels very, very different. Argentina, again, as part of the kind of the lithium triangle, has been a big producer of lithium. You've got Albemarle, Rio, Ganfeng in there. How does a company like yours do business in Argentina?
So for us, we're fortunate because we've been in Argentina for many years, and we've seen both the left and the right-wing governments, the Kirchners. You've seen Macri back to Kirchner, and through that period, the regulatory process has remained consistent. Fortunately, the provinces are the ones that enforce the mining code, even though it's a national mining code. So there isn't really a risk of nationalization. You don't have those sorts of components. However, what Milei's done, is really open up the jurisdiction in a way that had not been opened up before. And that's evidenced by the $10 billion that BHP and Rio spent there in 2024. Obviously Rio is with the Arcadium acquisition, which was lithium focused, and then BHP's investment into Filo de Sol, the copper project in San Juan. If you look globally, BHP and Rio Tinto didn't invest $10 billion anywhere else in the world. So it really speaks to Argentina, especially with the legislative reform like RIGI, the large investment incentive legislation that's come in, and the fiscal protections, the tax rates, the tax cuts. Milei has not only opened up mining, he's opened up the oil and gas sector. He's promoting labor reform. He's, minimizing the gap between the currency rates, between the blue and the black rates. Most importantly, inflation is coming down, unemployment is coming down. So in terms of his mandate to govern, it's very strong. He had a very big congressional win in the last round of elections. He's widely expected to be re-elected when he comes up for re-election in the next couple of years. So Milei is very pro-business, strong ties to America, and we're seeing that through the U.S. Critical Minerals Agreement and Framework, which has opened up U.S. Avenue funding, essentially making Argentina a state of the U.S. in terms of how they view the country. So, a lot of these, reforms weren't in place under the Kirchner government, which is really helping companies come into Argentina. Argentina is very much open for business. They don't want red tape. They don't want environmental permits sitting in offices for 12 months. They want jobs, taxes, and royalties. And they're creating a legislative reform to achieve that goal. And we're seeing that now, especially with, a lot of the companies that are submitting these projects into RIGI. One that stands out is Glencore's El Pachón. It's a copper project they've had for many years, was not really worked on, and now it's into RIGI. They're going into development and ramping up activities. So a lot of the majors are increasing their presence in Argentina. Rio Tinto is the greatest example. 5 years ago, they didn't own any lithium projects in the Puna. If you go across the triangle in the Argentine country, you've got Jujuy, Catamarca, and Salta. There's 17 salars, no more, no less, which also creates a scarcity element. The barrier to entry now is that the price is going up with a lot of these salars consolidated. But if you look at the Argentine Puna, it's controlled in reality by Ganfeng and Rio Tinto. They own probably about 70% of the major land positions of what are called the Tier 1 salars, which are economically viable and going into production. And a lot of these projects have now been submitted to RIGI. So Argentina has very much changed under what was the Kirchner government. The public service is definitely with a new agenda. And it's not that Argentina, if you knew how to operate, you could operate. For example, Orocobre, which is now part of Rio Tinto, when the Olaroz project was operated under Orocobre, they got their environmental permits. They went into production. That was 2008 to 2013, 15. So different governments that came in. But having said that, now it's accelerated, and you're seeing projects get approvals faster. Red tape is being cut. And it's a lot easier, with the lifting of currency controls, with these sorts of elements coming in, it's a lot easier for foreign companies to operate in Argentina, arguably than many of the countries in Latin America.
Right, and given your track record for yourself and the team you've explained earlier, how, and in this new kind of economic environment where under Milei and the sort of less red tape, as you say, how does that change things from the way that you've done them before? Because I'm interested in understanding what exactly is the opportunity, what is the business model that you're selling me, and therefore what's the opportunity for me as an investor?
Absolutely. So the business model for us is we've got our Rio Grande Sur project. We released a 5,000 ton PFS at the start of the year. That number was predicated on us bringing something that was realistic to market. Within the lithium space over the past couple of years, you've seen some very, pie in the sky ideologies of companies coming out with massive capex bills, impressive NPV numbers, but we wanted something pragmatic that a company of our size could realistically finance. And we landed on that 120 million of capex. And that's something that we've found that we can actually finance in the market, even being a 20 mil market cap Australian junior. We can raise the funding, the debt covenants, and the serviceability of the debt, and how we've positioned the project is real and tangible. So starting with that now, it's working through the critical path to bring that project into production. Where Argentina focuses, we're in a jurisdiction where if you look around us and if you look within a 10-kilometer radius, we have the Mariana project operated by Ganfeng, which is a project that has been brought into production. And it gives that evidentiary proof to investors that we're not somewhere where we're sitting by ourselves. We're in a tier 1 jurisdiction where you've got all of the majors now lining up to enter, headlined by Rio Tinto. We have a project that's pragmatic and realistic to being able to finance, and also with the economics, the operational metrics of the project still stand out. Our C1 production cost is $6,500 per ton for lithium carbonate, placing us in the lowest quartile of the global cost curve. We're ahead of all of the projects that are hard rock. Hard rock traditionally sits between $10,000 to $20,000 per ton to land a ton of lithium carbonate in China. So, from our perspective, the project and the value proposition for us is we're very cheap in terms of our resource, what we have, the pilot plant, the de-risking that we've gone through, and we have a tangible, realistic prospect of bringing this project into production. But even more so, we're also now working on other alternatives once we've got stage 1 done, looking at larger production scales that we can expand in time. So if you look at Pursuit, we're in a very good position where the market has turned from that surplus to deficit. And we're seeing that with prices, $20,000 per ton plus for majority of this year. And frankly, I don't think many analysts caught that in terms of the market moving so quickly. So we're moving into a rising price environment with a project that is realistic supply and it's attracting attention from offtake partners given the nature of the project. So we have a real value proposition where we can significantly re-rate the company, achieving those milestones along the way through to production as we progress the project.
Well, let's talk about that in terms of those re-rating moments, because companies say that and then maybe get a little bit disappointed because the market doesn't understand it. So let's try and work out what the market is not getting. Okay, market cap around 20 million at the moment. You're surrounded by, say, Ganfeng, Albemarle. You're in the right part of the world. Explain the bit where you say it used to be a case of you build this thing as big as you can. Hopefully someone comes along and takes you out and they use their balance sheet to build this thing out. You said, no, we're going to try and get into production with a smaller project initially, with a low capex, something that could be achievable. Why is that the smart thing in this market? Because if I look historically, you've got, the JP Morgans of this world will look at the bigger projects and say, well, they'll just turn up the dial somewhat and they'll kind of fill that kind of supply demand gap. Small companies can't possibly compete with that. Why can you compete?
So for us, first of all, we have a product that is validated in the market. It's technical grade 99.5% lithium carbonate. So our pilot plant has de-risked our flow sheet and has validated the product. And that's a big element for us. We've sent those product samples to Europe, to the US, to Asia, and we've had multiple customers come back and say, yep, tick, that's the product I want. Importantly, from there now, it's about, okay, how do we finance this, which is a debt equity scenario where, yes, you do have big companies using their balance sheet and developing these projects. And we've seen that, even with the biggest companies like POSCO, who are in Argentina, they developed the Salta Oro project, which is north of Salta Vida. They raised $660 million to do that from the market, and they're currently bringing that into production. From our perspective, going back to the size, that was a critical element. So first of all, a 5,000 ton plant is, I don't want to say easier because lithium is chemical engineering and nothing about it's easy, but it's more manageable to bring a 5,000 ton plant on. It's a smaller scale operation. It doesn't require the complexities of, say, a 40,000 ton operation that comes into production. Bear in mind, majority of lithium plants are around the 20,000 ton mark. There's only a few of the major companies that build larger scale production facilities, whereas the people that are bringing on 100,000 tons, and some of them are in the market, some of them in Argentina, the complexity of those operations and the risk of something being very detrimental in the ramp up is significant. Lithium brine is not traditional mining. You're not mining rocks out of the ground. It's chemical engineering from a brine-based lithium concentrate that goes through a solvent extraction plant and produces a crystallized powder at the end. If in simple terms, imagine you've got a compass going north, except you go a degree to the right. The further you go, being the increase in tonnage, the further off course you are. So that's the risk profile that comes with, say, a 100,000 ton plant. We've seen the market also respond really well to these plants and this sort of strategy. An ASX, an ASX company, Argosy Minerals, also Argentina, had a lot of success in the last lithium boom, where they brought on a 2,000 ton plant at Rincon and reached $1 billion market capitalization at one point. And whilst most of that was unfortunately given back with the decline in lithium prices, investors resonated with the let's go small first and larger later strategy. So for us, we wanted something that was a little bit bigger and a bit more meaningful to off-takers. 2,000 tons is still pilot level, but 5,000 tons is a decent amount of product that off-takers, OEMs look at that and go, that's the security of supply that I need for the coming years, can invest into the project and then secure the larger scale, which we're currently working on with addendums to our PFS. So in terms of financing, we've seen multiple ASX companies work with, prepay offtakes, debt scenarios, be it bank debt. We've seen Euro bonds with some ASX gold producers be quite attractive. We've seen strategic partners write massive checks for operations, in some very spicy jurisdictions as well. So, given the strength of Argentina, say, versus Africa in terms of a country risk being considerably ahead, we're seeing there are quite a few pathways that we can take to actually bring the project online. So going back to the strategy, if someone wants to come along and take us out during that process, absolutely. But we're not a 20 mil market cap company saying, hey, we need to raise $1 billion to build this thing, which is just never going to happen. It's not realistic and really affects your credibility when you go to market. Where when I'm presenting the project and I speak to various investors, and financiers in New York and Europe and Australia, people resonate with the strategy and they go, yep, no, that's something you can actually do and actually succeed with, which puts us ahead of the pack, so to speak.
Okay, I've kind of jumped a little bit in. Maybe give us the numbers from the PFS. We get a sense of the returns that you're offering as well.
Yeah, absolutely. So the NPV on the PFS was around 364 million for the 5,000 tons of carbonate. It was about 157 million capex, including the interest paid on finance costs. The actual capex is around 25 million, but you've got a 3-year startup period. IRR is around 22%, and the OPEX, as mentioned earlier, is 6,521 per ton. So very healthy revenues, very healthy EBITDA. Importantly, the debt service coverage ratios were all exceeding what we would expect as normal bank covenants. So the project can survive in terms of with the debt, but also the sensitivity analysis. If the project drops off, 30% in terms of the price coming off 30%, it's still able to hit its debt obligations and will still be profitable. So from that perspective, we've got a very, very promising project that as we refine those numbers, as we work towards detailed engineering and the bankable feasibility study of it, it's a very promising start that when we start looking at this project can attract finance to get it into construction.
Right. Okay. And look, I get you've got the option of maybe someone comes along and takes us out. But if you're going to go to the end, and we'll come back to financing in a second. And technically, you rightly said it's a very sort of technical metal in that sense, albeit one of the easier. It's not DLE, for instance. How do you move things forward from a PFS to DFS technically? Who are you working with? And ultimately, who builds this thing if you do have to finance it?
So all of our contractors are actually based in country in Argentina. So we have a group of very well-credentialed geologists and a very well-credentialed group of chemical engineers that have worked on numerous projects. So for example, the chemical engineering team that's heading our project development, they've got contracts with Rio Tinto, they've had contracts with Galan Lithium, they've had contracts with Plus Petrol, which had Lithium Resources, which had 400,000 hectares of various salars. So very well-credentialed chemical engineers. Our lead geologist is an independent contractor who was a former head of exploration for Barrick Gold. He's a CP in lithium, CP in gold, CP in copper. So very well-credentialed in-country team. And to me, that's a strength. We're not using people sitting in Australia or people sitting in the US. We're using Argentinians in Argentina, which also gives us an advantage when they need to go to site, when they need to contact locals. It also gives us an advantage as our engineering team. We asked the same question: who can we get to build this? And he knew off the top of his head all of the engineering contractors and the project builders that will build the various elements. And having had done that previously, so some of those contractors have been used to construct the pilot plant, and in terms of equipment sourcing, the mixing tanks, the filter press, we know where to go to get all the equipment to actually build out the lithium carbonate plant. So we've got a very well-credentialed in-country team where we know where to source the equipment, we know who's contracting it, and we also have the guys who can take it from PFS through to the bankable feasibility study, DFS, I think it's ACCC engineering level 2 and 1. So very well-credentialed team in Argentina leading the project development for us.
Okay, and let's come back to the money side of things, okay? Because, like I say, there's a bunch of stuff that's got to go right for you in terms of maybe the lithium price keeps moving to, and hopefully sensibly moving up. Your capex isn't great, but isn't big, which is good news. But as a 7-year payback, right? It's if I'm a PE firm looking at putting money in, or if I'm one of the kind of bigger lenders, I'm going to be looking at that and say, well, how does that change? Can you change that? And on what basis is it? I don't know what price assumptions you've made on your PFS. What else can you do to improve that side of the numbers?
Yeah, look, so it is a 7-year payback, and most of the debt facilities that we've been in discussion with are 5 to 7 year terms. So they fit nicely within the covenants without having to do that. The first thing that will always stick out is the cyclical nature of lithium. Whilst we've used conservative forecasts in the 20,000s, and we use Canaccord Genuity's long-term forecasts, for our PFS, which were 21,700 per ton from memory. The reality of lithium is it can spike to 40 to 50,000 tons, per ton, and it can do that for a 6 to 12 month period. If you look at 2023, it was elevated significantly. That gave companies like PLS several billion on their balance sheet because they were selling lithium while the price was high. So for us, I personally think that whilst it's more of the wild card opportunity, that wildcard opportunity could be very realistic come 2028 to 2030 when you're going from the 1.5, 1.6 million tons. Forecasted demand is 2.3 to 2.4 to 2.5 million tons over that period, all the way to 3 million tons. If we get a market squeeze, it is highly likely that lithium prices can spike and elevate, which then cuts the payback because you're obviously making a lot more in terms of revenue. For us, look, we can increase the amount that we pay back. You can run and you can pull the payback, to run the company a bit more fine. But for where we were sitting, we wanted some breathing room to not overextend it. So, a price increase will do that. And then also when we are looking at expanded output scenarios, when you increase the scale of the project in terms of where the capex sits, for the increased revenue, increased EBITDA, it does lower the payback as well. So within that project, within the 5,000 tons, the equity component is self-funded after 4 years of production to then expand the project to a larger scale. So you're using debt. So we do have that option where we can then pull the funding down from there. So there are options to decrease the payback. Personally, I think the most exciting one is to see if we have another lithium bull run at some point where the price spikes, 30, 40, 50,000 per ton. And that's where you want to be really well positioned and getting into production around that period so you can take advantage of those price spikes.
Okay, I hear what you're saying. You paid up down a bit quick because you've got this free cash flow of like 50, 60 million bucks a year, right? You should say, we've chosen 7 years as a number because it's acceptable to the debt providers. It's not. That's the best we can do. Yeah,
no, and that was good. You can get more aggressive and obviously push the cash flow back, and you can pay down more money faster. But having said that, it is acceptable. The 5 to 7 year terms are acceptable to debt financiers, and we've received term sheets with 5 to 7 years on them for looking at the debt component. So we're very comfortable with where the project economics sit in terms of the ability to raise capital off them.
Right. Okay. And can come back to that you said about at that base, it's a case of like show the ability to get into production, and then maybe show how you can ramp up potentially with this kind of free cash flow that you're talking about. And what could that profile sensibly look like in terms of this kind of modularity to what you're building? Well, I know it's only PFS at the moment, but give me a sense of.
We're entertaining a 12,500 ton stage 2 expansion, so to go to 17,500 ton. Our PFS addendums are focusing on a lithium chloride scenario and a lithium carbonate scenario. The lithium chloride element came into that as that was offtake partner driven, where we had requests from several parties that were more interested in lithium chloride than lithium carbonate. And that's reflective of the market. Just as a general
Explain
observation.
those for people not so aware. What's the difference?
So lithium carbonate is the predominant material used in LFP batteries, lithium iron phosphate batteries. It's a more refined version of lithium that can go all the way up to medical grade, which is almost pure lithium in a powder. Lithium chloride is a couple of steps behind. It hasn't been carbonated, but it's still a crystallized powder, which normally sits at 99% technical grade. Many Asian refineries will purchase lithium chloride as a preferential material, and the upstream processing technology in China is more advanced than Europe and the US. So they'll take the lithium chloride and refine it to ultra high grade, 99.99% battery grade lithium carbonate. It's very well mainstream. Ganfeng do this. Many of the Korean producers do this as well. And that's just a reflection that, I think it's 85% of lithium processing and refining is in China. They've had the technology for many years. So it's more a factor on their supply chains than market preference. All of the product in LFP batteries is lithium carbonate. The NCM batteries was lithium hydroxide. And those end products are all achieved, be it through a spodumene turned into a lithium chloride, turned into carbonate, straight lithium carbonate from operations, but they all end up in the same place. It's just a different route to getting there.
Right. Okay. Interesting. So the offtake component is going to be kind of quite important. Well, the markets are going to be quite important to you, the pricing, and ultimately your margins are going to be important to you. It as part of this kind of the pilot and the testing that you referred earlier in the conversation, were those sort of continual? Was that material produced continuously, or were these kind of like shorter batches done for different off-takers?
So these were we batch processed our lithium from the pilot plant. So the pilot plant can run continuously and produce 250 tons a year, but that's an intensive process. It's capital intensive, where we were at the stage where we wanted to ensure that we could also drill, we could do engineering works and all the rest. So we produced enough lithium carbonate in several batches for various parties. We sent that overseas for CA, for product acceptance. And then we've worked backwards now, having done that, where we're doing the drilling, we're doing the engineering in conjunction. So, but the pilot validation is key. It is a massive, massive factor for, and I think it's one that's very much underestimated in the market, because you get a lot of people that come with, fancy flow sheets for projects in Canada, in Africa, in, Chile, Argentina, and it's an engineering sheet. It isn't actually real world tested, whereas we have actually produced using the flow sheet in a pilot plant, which is a technical de-risking of the project. One of the elements that we're now doing, and we've just been permitted for, is the relocation of our pilot plant to site. Once you move the pilot plant to site, you're operating under real-world conditions, where, for example, at 4,000 meters above sea level, water boils at 80 degrees, not 100 degrees when you're at sea level. So you have to factor that into your chemical, your flow sheet and your reactions and all the rest. When you're producing the product consistently at site, it's no longer about proof of concept. It's all about scale. How can you take 250 tons and make it 5,000 and moving that? And the pilot plant does play a critical role in ramp up, as you're testing, pond systems, filtration systems in real time as you're building a plant. So it's the pilot plant is a very critical piece that I think a lot of people have missed, where, when you have these operations that go into production, if you don't have a pilot plant, if you don't have the on-site testing, you don't have the validation, you can run into serious ramp up issues. And frankly, some technologies will do that. DLE has seen probably 4 or 5 various companies that have run into strife, even with pilot plants, because DLE is a relatively new technology, where we're fortunate that we're using a tried, tested, conventional processing route. Same route that Albemarle, SQM, Rio Tinto, majority of their projects use. So we're not reinventing the wheel, but we have that added benefit where if you are a lithium junior and you have a resource, okay, how do you know that you can actually produce the product? We have a pilot plant that's done it, and I can hand you a kilo of it that you can go back and test and tell me how it sits within your specification, which we've had multiple parties go, yep, this meets all of our impurity profile needs, it meets all of our content needs. Can we look at investing, or can we look at offtake, because this is what we're after? So that's a very big value add that I think has been missed by the market, as we've developed that along.
And so, how long was the plant operate on site in terms? Well, I was on site derived brines before. That either lenders, presumably probably less so, but more strategic partners regard the flow sheet as demonstrably deliverable.
So there's two parts to it. So it's operated now with, you've got evaporated brine that's trucked into the plant and run. So the circuit is complete, and that's proof of concept that a lot of the off-takers have gone, yeah, that's enough as it is. From a lending component, the BFS, PFS levels are more important, I would say. Going through the engineering works, but also having that pilot plant does assist. Having it operating at site, does assist in terms of comfort and security for the lenders going, yep, this is a real world operation that's actually being built. So the comfort is mostly derived from the offtake parties that are all interested. Traditional corporate finance banking has different covenant sets, but look, some of them have shown a lot of interest in the plant and going, yep, that's actually a box tick that you have something that de-risks and validates the scale of the project.
Okay, but do you get at what point do you get to when you say, well, we need to maybe choose a principal product rather than preserve this kind of multi-development optionality that you've been talking about here? What?
Yeah, offtake partners. So for us, it's about attaching an offtake partner to the project, and that's for a couple of reasons. The first of all is it requires capital and money to develop these systems and moving the project forward to detailed engineering. For us, we've presented a PFS across multiple scenarios for two very sought-after product streams that we're bringing to market, that it's now, okay, what are we producing? Lithium chloride, lithium carbonate, we need to pick one. We can't do both. It has to have a final output. And we've seen this in the market with companies like Galan Lithium. They went from carbonate to chloride and eventually brought their plant online with relative success. We need to follow the same path, and that's offtake driven, as lithium in itself is not like iron ore, it's not like copper, it's not like coal. It has an end user specific market where the specification for the product differentiates across all different end users. And it can sometimes get fairly drastic from Europe to Asia in terms of differences in the impurity profile and what customers will accept. So you need an end user customer with a product specification that you essentially take the PFS from, work through your detailed engineering, and almost bridge the two together so you're hitting that product spec for that customer. For us, that's the pathway that we're taking. And look, some companies do sell into the market, but majority of the newer production, so for example, Orocobre, which came on with Olaroz, the specification was driven by their 30% JV partner, Toyota Toshu. So Toyota drove the chemical specification for that product and that product output. At least initially, that may have changed, obviously, under Rio Tinto, who may prefer to sell things into the spot market and all the rest. So, from our perspective, it's about attaching that offtake partner to define the engineering pathway and then set where we're going through on detailed engineering to then go through to the construction phase. And it also has an offtake partner, a willing, ready buyer to buy that product, which then assists with the financing component as well.
So obviously, offtake partner is going to get access to lots of information. But in terms of for someone like me, he can sort of look around for comps and go, well, do these guys stack up? There's lots of people that follow a similar process. It's technical, but it's also probably the simplest recovery process. In this sense, what I'd like to be able to do is try and comp you for recovery or reagent consumption or residence time or product consistency, etc., against other groups, and say, well, are these guys good enough? Is this going to be attractive going forward? So, at what point do we get to see that sort of data to do our own research and background, and not just be reliant on BFS presence?
Yeah, look, so some of that data is in the market now. I mean, look, on terms of consumption reagent data, we put some of that out in the PFS, and I've seen, independent research that have comped us lower than, for example, LKE, Lake Resources, albeit they're using a DLE process. We are a little bit higher than, for example, Galan Lithium, but Galan sits on Hombre Muerto, which is the best salar in Argentina with the highest lithium grades and the lowest impurity profile. So we are at the lower end of the cost components for reagents. We are one of the better performers. When you compare us to example for Argosy Minerals, they're at Rincon, they're dealing with a 16:1 to 20:1 magnesium ratio. We sit lower at 10:1. Our magnesium ratio has been dealt with in our processing flow sheet, and we've put that out, and there's been comps on that. So we do have that data in the market where people can go and look at us and say, yep, no, these guys actually stack up. They're in the lower quartile of the projects. The project metrics are favorable against projects. For example, Rincon's always been difficult. It's got a very high magnesium ratio, and magnesium is something that's quite, it needs to be treated in the right way. There are projects with high calcium values. Our calcium values are, again, manageable and consistent with a conventional process that we can pull out economically. So, when you look at those data sets, and importantly, we're not using DLE because of low recovery. So the lithium grade sits at 434. We are pumping, our well field will pump from values between 500 and 600 mgl Li. We're currently drilling Mito at the moment, which is adjacent to a hole that hit 900 mgl Li from a competitor. So, when you look at grades, for example, on Positos, which was known as not economically viable, it has 50 to 100 mgl Li, it needs DLE, and it can't recover lithium. So, we're in a tier 1 salar that can do that. And for us, we're very comfortable with the comparative profile of where we sit in the project universe. And that data being in the market has had inbound approaches from offtake partners and people looking and going, yep, no, this is something we want to have a deeper look at, because the data stacks up that you are in a better position of people than, say, Argosy having to deal with, the magnesium issues. We don't have those issues. Not saying that they won't deal with them. They're a very credible team, but, we don't have the problems they face. It's a different set of problems which go down to the salar characteristics. And Rio Grande sits there as one of the better salars within Argentina to develop and operate at the moment.
Okay. Let's so just want to come back before I kind of dive into the thing. Something you talked about earlier, or we talked about earlier, with regards to, the stuff that you're not in control of, waiting around for a price spike, and the stuff that you are in control of. I'm interested in the land consolidation that you've done, and that I call it REMSA. I don't know how REMSA agreement. You picked up a lot more land there. I mean, was there competition for that? I mean, why? And that's obviously next door to Mito, but why did you feel the need to kind of pick that up? Was there any?
Oh, absolutely.
Because I'm saying what's the opportunity there? Are there any constraints attached to that? I'm just wondering whether you got it when others maybe didn't look at it.
No, look, we were really fortunate to go through the process. So REMSA do a public tender where companies go in and bid for the projects. We were able to successfully work with REMSA to have a bid that they accepted. We were successful in getting those plots. When you look around at lithium in terms of competition for land, it is extreme, and I cannot push this far enough. And in every presentation, I always talk about this. If you go back to the Argentine Puna, you've got 17 salars. There's no more, there's no less. There are a few outliers like Tres Quebradas and some of the salars that aren't within the mainstream, but majority of these have been discovered. You can see the white halite when from space. Jump on Google Earth, you can see where all the lithium salars are. If you look at the lithium sector since when I started my career in 2006, you had probably 50 to 60 different owners. Majority of that now is consolidated, and you start going through, you've got Lithium Argentinas, which is Caucharí Olaroz. You have Rio Tinto, which is Olaroz. You start coming down, you've got Pozuelos, which is predominantly owned by Ganfeng. Pastos Grandes around that area, predominantly Ganfeng. Centenario is Eramet. Then you've got Hombre Muerto, which is now majority owned by Rio Tinto. You've got Ganfeng at Mariana, and you start picking up a common theme. Every company I've mentioned is a multi-billion-dollar major. There are not many juniors that are actively left outside of myself, Argosy, Galan, a few of the names I've mentioned. Importantly, Rio Tinto is not going to sell a project for $10 million. They're not going to sell Rincon that they purchased for I think it was nearly $900 million for $10 million. They're going to be wanting big acquisition money if someone comes along and tries to buy it. the scarcity factor starts coming into play significantly. So if you go through the top 10 mining companies globally, outside of Rio Tinto, the following 9 don't have exposure to lithium, and they will need to build lithium into their portfolios. And whilst you've had various CEOs that have been, lithium's a fad, etc., the simple reality is lithium's not going away. It's been around in production in Argentina since '87. It's driven in majority of applications, electric vehicles, BESS energy storage, medical, pharmaceutical, all the works, it's there. So from that perspective, you start looking, all right, if you've got BHP, Anglo-Teck, Glencore, what are the assets they're actually going to buy? A lot of these companies have criteria of they need size, they need scale, and they need, tier 1 almost credential. Coming back to Rio Grande, we looked at that and said, well, hold on, we sit on a salar that the whole salar probably has about 30 million tons of resource in it. We do have other competitors. There's a TSX company that has some quite a lot of ground that's in the mountains, but they've got about, we have about 1,000 hectares on the salar. They're about 600-700 on the salar. They've had some great results off the salar. And then there's a major company called Plus Petrol that owns majority of the salar. It's very well known that Plus Petrol was actively looking to sell the project. They engaged Deutsche Bank to try and sell. Couldn't get a buyer in the down market. I suspect that'll change now with lithium over the coming years. However, getting into that and buying that area is very, very difficult. The land tenures, getting on salar site ground is rare as hen's teeth. And just because majors now own majority of the positions, you can't get it, and some of the salars are not economically viable. Positos, very well known not to be economically viable, doesn't have a lithium grade that's high enough. So when you look at the areas, you're not getting into Centenario. Eramet, the French company, has that cornered. You're not getting into Pastos Grandes. Ganfeng has that cornered. You're not getting into Olaroz. That's been relatively cornered. And whilst there are some exceptions like LEL that did have the Solaroz project, that was postage stamps around the outside that they managed to sell, and I think it was nearly 100 million US that they sold that for as well. So with that said, the further time goes on, it's harder to actually find decent ground that has viable lithium content, a viable impurity profile. And then when it comes to projects like us, a JORC resource, PFS, and pilot plant. So in terms of the security of when we saw that Ramsey-Graham, that's fantastic for us. It was directly bordering our existing Mito tenement. They were all conjoined, and it had some on-salar access. But importantly, that ridge at Mito, we're drilling around 500 meters. We just hit a great aquifer around 500 meters, actually overnight. The brine probe, we released an announcement earlier in the market where the brine, we were getting packer samples, with some very good soluble brine coming out. So the exploration potential of Mito to expand our project is quite significant material. And then also there's we originally pegged Mito for infrastructure. So the pond layout was out there, but it has both more ground for infrastructure, more ground for resources. But I think when it comes to Rio Grande, the scarcity element of being able to buy on that salar, there's 3 parties and we all have it pretty well locked down, I would dare say. And then if you're looking to get into the market, it's significantly harder, So I think we were very fortunate to secure that ground, but it also has a long-term play where if we just sit and wait and don't do anything, Rio Grande will eventually be sold. Someone with big, deep pockets will come in, will buy it. And if they're buying any of the 3 companies on the salar, they're going to buy the other 2. And that just makes a consolidation play inevitable in the future.
So what's more valuable to investors in a market like this? Are you saying to me, we think the money's available to move this forward ourselves, and that's what we're going to do? Or would it make more sense to bring in a strategic partner now, use their balance sheet to kind of move this thing forward so you're not, diluting the heck out of everyone? Or maybe just, it's the long game here. So what am I buying into as an investor?
So as an investor, the proposition is almost a combination of all 3. So you're buying into a company that has solid fundamentals regardless of, the market forces, investors and strategics and all the rest. This is a project that can walk up the value curve into production with a tangible and realistic pathway. We're not sitting here saying, hey, give us $700 million and we'll build a massive project. No, we've got a viable, financeable project, and we can point to various ASX companies that are in different commodities that have used Eurobonds, debt finance. There's those pathways available to us. Importantly, however, you're walking into a project in a lithium market where it is going from surplus to deficit, and surplus to deficit always creates M&A opportunities. And we saw that in 22, 23. When the market was in a significant deficit, there was acquisition activity across Pastos Grandes, Jujajaca, which is Mariana, that was there. You had Arizaro being picked up by multiple different companies through REMSA tenders. There were quite a few acquisitions across both, projects which I'll call project level like ours, and they were all in the hundreds of millions. And then you had the Arcadium acquisition, which was a producer in the billions. So, from our perspective, we're walking into a market where heightened M&A activity is inevitable. But on top of that, there is the optionality for us bringing in an offtake partner where we're increasing the value. So, an acquisition can happen at any time. Someone could come along tomorrow, knock on the door and say, hey, we want to buy it. What's your value? But from our perspective, as we continue to develop the project, that price gets more expensive. And unlike several others that are in our position with low market caps, if you're a sub 100 mil market cap company raising or trying to raise $700 million or $800 million, it's a big ask. And we're not in that position. We have something we can finance and move forward. So added to that, we do have a gold project that has some great optionality on it. And we've seen that. We picked up that project at the end of last year. It was a great project that was very similar to Serra Negra, which has gone through various, it's 100 k's north of that project, various acquisition cycles, eventually bought out for $4 billion by Newmont. I'd like to think my chairman knows a thing or two about gold exploration, given he's the chair of Southern Cross Gold, which is a multi-billion-dollar gold explorer. He was very bullish on the project. So when you look at the value proposition, we have multiple re-rate opportunities that are coming up through, things that are quite basic. Hits on the gold project. If we get a significant intercept on the gold project, the share price can re-rate. Rising tides then lift all boats. You then can work on the lithium project, which unlocks, financing where you need to be of a certain size. The lithium project, we're about to announce drill results from DDH3, which is being in completion. We're doing DDH4 on the REMSA ground. We have PFS addendums coming out. We're down the path with several parties in terms of offtake, strategic finance, and we're looking to culminate an MOU so we can start moving towards detailed engineering. You've got relocation of the pilot plant. We're permitting the project, so we'll have our 5,000 ton permits by the end of this year to actually start construction and building the project. Same with the gold, working through the exploration. So when it all comes together, the lithium is always our flagship, always has been. But when it comes together, it's an opportunity where you're coming into pursuit at a point of, right, this is where the market is. Not the best resources market, but the long-term fundamentals for lithium are just getting more attractive. And it goes back to what I said at the start of our discussion. Going from 1.5 million tons current capacity to 3 million tons in 3 years is a massive ask. It's doubling the current size of the market. And think of those projects, Atacama, the Greenbushes operations, the converters in China. You're basically taking one and putting another one identical next to it. That is a massive ask in terms of the market. So they're bringing on that supply, attaching a partner to it with a viable, tangible partner that's saying, yes, this is the product we're buying. We should see a re-rate in the price as we continue to develop the story. So from our perspective, however, there are outliers. As I said, in 23, you saw a flurry of acquisitions in the lithium space by heightened prices. And Pursuit's very well positioned for that. We're on what I call a frontier salar. It's got 30 million tons of product in the ground. And if we're the only producer on that salar, it probably puts us ahead of our competitors there. But I mean, Rio Grande in itself, the whole salar is a area for a major to come in and develop a 40, 50, 100,000 ton operation. And if you've got a 5,000 ton plant already there, we look really attractive to anyone going, hey, these guys have de-risked the flow sheet, they've proven the concept, they've got it into production. So now it's about scale, and you've got all of this resource here where you're just going from 5 to 60. It's a much easier process route than, say, going from 0 to 100, and then let's throw in DLE to make it more complicated, which is unproven at that scale. So, Pursuit's got a very nice little blue sky opportunity there, but we also have a pragmatic, traditional, one of the guys said to me, a less on hard curve, pathway of growth where it's, we've done the hard work to get a resource, PFS. It's now going through that detailed engineering with a partner and then financing a tangible and realistic financing pathway to commence construction. Then you're generating cash flow. So there's both pathways available to Pursuit over the coming years, which we're quite excited about.